Then we're proceeding to our fourth speaker, and here follows the presentation of Mr. Ole-Ricard Hammer, Chief Analyst of Platou.
Thank you. Ladies and gentlemen, an honor to be here. Being a Norwegian, asked to come to Greece and talk about shipping, I'm very honored and proud to be here. My topic today is talking about some trends in the tanker market, and I believe, let's see here, there we go. Yes, and the issue before us is whether this market has any kind of cyclicality left in it. My answer, Aristotle's answer, is definitely yes, but I want to bring up this first slide to remind you of the duration of tanker market cycles. They tend to be very long. The period of bouncing along the bottom can also be quite long, which is why we should focus on this slide. It also reminds us of the legacy of this industry, where we have very long lead times on the supply side on fleet additions and removals, and we have very short lead times on the change in the world economy. So that is a legacy of shipping as a special industry. On a general basis, however, for all markets, we have to remember that the news flow that influences our decisions tends to be pro-cyclical. In other words, the good news is always fantastic at the top of the market, which tends to encourage people in a certain kind of way, and the bad news is always at its worst at the bottom of the market, which tends to move them in another way. So it becomes self-reinforcing. So the question now is whether we have so much bad news discounted in this market that we can begin to look at a bit of a cyclical upturn. We think we are approaching that period. But there are, of course, a number of potential sharks in the ocean, as we shall see. Our number one point here is to discuss the current situation relative to the past period of the 1970s and the 80s. And in our view, we have a much smaller degree of overcapacity in shipping. The 70s and 1980s, in our view, will go down as a truly spectacular period in shipping, in which we created a huge number of overcapacity, estimated here at more than 30%, and kept that overcapacity in the market for a long time. In the current situation, our estimate is that we have an overcapacity of between 5 and 10%. We would not call that structural overcapacity. We would call it cyclical overcapacity. And the good news is that for all the mistakes that we have made, we are seeing the industry responding to market forces, notably on the supply side of the market. If values and rates go down, you order fewer vessels, you build fewer vessels, and you begin to correct yourself. That is what's happening now. That is what was not happening in the 70s and the 80s. So we believe that our starting point is better. We are not in that structural overcapacity situation. One of the headwinds we are fighting, definitely, is what's happening with the world economy, which is in a weak mode, and that's also influencing oil demand. Here, the world economy is on the bars, and the oil demand is on the line. We are at less than 1% growth. But you should also think about this as maybe it is the supply of oil that is the problem, because tankers rely on oil transportation. Oil needs to be produced. And the problem now is that we are in a crunch in the global oil market where we are having trouble raising production. If you follow offshore, if you follow the oil market, you know that a lot of money is being invested in creating an increase in oil production. We believe that is going to come and become more visible in the years ahead. But right now we are in the low point where we have very little production growth that follows with high oil prices, limited trade volume and weak growth in demand. We think that a change, an improvement in oil production is gradually going to come. A special factor now relating to this is what's happening in the U.S. U.S. used to be the biggest client in the tanker industry. It's now probably the second biggest, close to the biggest, but it used to be the biggest by far. Now things are changing. This is a slightly complicated graph, but you should focus on the red line, which shows the annual change in seaborne crude oil imports into the U.S. And it shows that we have been going down almost every year by about 500,000 barrels per day. That is a huge volume. On the bars, you have the different reasons for why these oil imports have gone down. It's a function of demand in the U.S., which generally has been weaker. Production in the U.S. is now shooting up to the stars, is very strong, and they are importing more from Canada on pipeline, which does not help the tankers. I've inverted some of these figures to illustrate, but you can figure that out later. The point is the red line, U.S. is importing a lot less oil. Now, if you look at some forecasts, this is going to continue over the next 5 to 10 years. The U.S. is going to become a lot less import dependent. In our view, this can be questioned and should be questioned at the current point in the cycle. All of the assumptions on the U.S. reducing its imports relies on assumptions on demand for oil, production in the U.S., and access to oil from Canada. All of these assumptions can be analyzed and should be tested. We think the world is going to be more dynamic in how the market adjusts, and we also think that a barrel lost on the U.S. oil imports is not necessarily at all a barrel lost to the global trade. So yes, it's a challenge that the U.S. continues to reduce its imports, but no, it does not go hand in hand with saying that the tanker market will be, demand for tankers will be destroyed over the next 5 years. A lot of assumptions on this graph, which we all should dig deeper into and question. And at the current point of the market, that's necessary to do, because for all the good things that we can say about the clever analysts, they tend to be wrong at the top of the market, and they tend to be wrong at the bottom of the market, because emotions that are created at these peaks distract the analyst from the core thinking of the fundamentals, okay? So the analysts, a lot of good things to say about them, but they are often wrong at the turning points. Now, going further on this, and thinking about tanker demand, I want to draw your attention to tanker demand. Most of you, including myself, would think about tanker demand as an extra barrel produced and put onto a vessel. But that's only part of the story. When we factor in distances, which of course are extremely important, we factor in productivity, we factor in vessel load factors, we factor in things like floating storage, you get a picture of tonnage demand for tankers, which is quite complex, okay? It's not just about the 1 barrel produced. So again, going back to what I'm saying about the U.S., I'm saying that a barrel less imported into the U.S. is not the equivalent of a barrel less transported on the global market, because the global market is going to adjust. The players not selling oil to the U.S. would probably sell it elsewhere. And listen to what is happening in the U.S. now, where they are beginning to contemplate the possibility of returning to the crude oil export scene, okay? So the message here is that it's a dynamic situation which may offer some good opportunities, and the question is, are you at the current point in the cycle with a severe decline in tanker asset values, are you being paid to possibly take on some of that risk? And in our opinion, we are at least getting closer to a point where that may be interesting. I talked about the market's ability or lack of ability to adjust. In the 70s and the 80s, the market did not adjust to a drop in asset values and earnings. But things are different now. This is a graph showing the total tanker fleet as a percentage, the order book as a percentage of the current fleet. and we peaked at around 50% back in 2008. In other words, we did not need a financial crisis to bring this industry down severely. 50% order book is a phenomenally high number. The good news here, however, is how quickly the order book has been brought down. The market is responding to changing in the environment, and as has been very clearly said by my colleagues here, the banking side of this, of course, has played a huge role in bringing down, contributing to bringing down the order book. So now, on our figures, we're estimating the tanker order book at around 11%. You start to add together how big the tanker order book should be, given the replacement cycle of vessels, given the lead time of building a vessel, given the normal demand growth, you would get into that range. The tanker order book is being normalized, and it's happening relatively quickly. The last issue here that I want to talk about is yard capacity. This is a graph showing the new orders coming into the market across all sectors, and the line is our calculation of yard capacity. So into the 2000, we were running, the yard capacity was running behind the level of new orders coming in and had to catch up, and that forced prices higher. Since then, the last 5 years, yard capacity has been way above the level of incoming orders, which of course is creating downward pressure on prices. However, we're now beginning to see yard capacity beginning to adjust. Smaller entities, sub-suppliers are being cut off. There's been some closures, and we think yard capacity is beginning to come down. Again, we believe that is a sign of the shipping industry responding to market forces in a dynamic way and not staying in the same static position, which should be good news for the market's ability to begin returning to some kind of equilibrium. So let me close off by saying that we are not forecasting a sharp V-shaped turnaround in the tanker market. We think 2013 is going to be quite challenging. But in our view, we know that we are become quite low in the cycle. We think that there are good signs of the demand side of the market beginning to adjust. So we are beginning to put the pieces in place for a cyclical recovery in this market. We have a couple of headwinds, notably the notion that the US soon will become self-sufficient in oil. We think that could be subject to question. And those are the questions to be asked at such an extreme point in the cycle as we are in today. So let me close on that. We think with some positive remarks that we think we are beginning to round off the bottom in the tanker market, and there is some possibilities going forward. But never, as ever with shipping, not a risk-free sector. All of you know that. So I wish you all the best, and thank you for your attention.